We're going to investigate how withdrawing from retirement investments during a stock market decline affects the value of your accounts. So be aware, stay tuned for our full episode. Welcome back. This is Richard with Wisdom Investor. On this channel here, we investigate and explore various topics related to retirement, investing for retirement, Social Security, when to retire, how much money to save for retirement. Today, we're going to look at this concept here. If you retire in the first few years of your retirement, the stock market and your investments have a positive return versus if you go into retirement in the first few years of your retirement, your investments are down or the stock market is down. So this is very important to understand. And we're going to also take a look at a couple of solutions that you may want to take advantage of. This process we're going to take a look at is called sequence of returns, the effect of withdrawing from your retirement investment account during different periods of returns. We're going to take a look at a hypothetical example here. The first few years of your retirement, your returns are positive, and these are the returns that we're looking at. And then we're going to reverse the returns. The first few years of your retirement, your returns are negative. So if we look at our first example here, you'll see that the first few years were mostly all very positive, and the last few were negative. We're going to reverse that so that the first few years are negative and then the last few years are positive. And we're going to see how this affects our account balance. And you may be surprised. This first example we're going to look at, there's no withdrawals taking place yet. The second example, we'll look at the differences once we start taking withdrawals. Let's take a look at our chart here. We're going to start on the left-hand side. Our portfolio value is $500,000 to start with. And we see in the middle column is our returns. We're going to start with the negative returns in the early years of either saving for retirement or in retirement, and then end up with positive years at the end. We started with 46 as the age, but this could actually start at any age. On the right-hand side, we're still going to start with $500,000 portfolio value. In the middle is our returns. In this case, on the right-hand side, we're going to have more positive returns in the beginning and end up with more negative returns in the end. On the left-hand side here, you'll see down at the bottom, we end up with a value of $910,000. Ended up having a 4.8% return. So even if we reverse the returns here, we still end up with a 4.8% return in this case and save the same amount of money, $910,000. In the first example, there was no withdrawal from the investment account. In our second example here, we're going to add a $25,000 per year withdrawal from our investment account. Here's the second example here. Again, we have a $500,000 balance to begin with. Now we're going to add a $25,000 per year annual withdrawal. We still have the negative returns here in the beginning years and more positive returns in the end on the left-hand side, and then on the right-hand side, the same thing, $500,000 balance, $25,000 annual withdrawal, and we start with positive returns in the first few years and end up with negative returns. So let's see how this ends up here. We can see here if we start with the negative returns in the first few years of either saving for retirement or in retirement, if we look at our balance here down at the bottom, it has some detrimental effects here. The balance is $20,134. Now, if we compare it to the right-hand side where we started off with positive returns and ended up with some years of negative returns, the balance is $477,000. So that's a big difference. By having a few years of negative returns at the beginning of retirement, it can drastically affect the value of your accounts. We're looking at a chart of the S&P 500 index, the SPY. Now, for the first 7 months in 2022, the S&P 500 has been in a downtrend. What our analysis that we looked at is telling us that if we are withdrawing money from our retirement accounts in a downtrend, we have a higher chance of depleting our funds much faster than if the first few years were positive when we started withdrawing money from our retirement accounts. Now, one thing that makes this interesting, we never know how long a downtrend is going to last. We can see back here in the 2000 dot-com stock market crash. The markets were going down for about 2.5 years before we finally had a recovery. And then it took about 6 or 7 years for the market to get back to the previous highs. And then before you know it, we had another downturn. We're going to look at a couple of solutions here. Now, there's probably other ways to handle this situation so you don't deplete your funds in a downturn. If you have any ideas, leave a comment. Much appreciated. Let's take a look at our first solution here. Hold 1 to 2 years of cash in an emergency account. This is especially important if you've already retired because you're no longer going to have that cash flow from your employment. So very important to have some money put aside so that you don't have to withdraw from your investment accounts as the markets are moving down. The second idea we want to take a look at is increase your cash positions based on technical or economic indicators. For example, if your asset allocation is 100% in the stock market and you see that maybe you need to make some changes, you feel like the market's going to change, go to like a 50-50 asset allocation, 50% stocks, 50% cash. Now here's one of my favorite indicators that I like to use. We're looking at the NASDAQ 100 from top to bottom. This is down about 30% year to date. This is a current chart. The indicator I like to use, and we've talked about it before, is this RSI 30 indicator here at the top. When this indicator starts to move below the 50 line, then I will start to increase cash positions at that point. Now, we never know how long a dip in the market's going to be, but in this case, we've been down 7 months, and it may go much longer. If we go back to 2000, 2001 during the dot-com stock market crash, and if we look at this indicator here, it started to drop below the 50 line here. Now, we're not trying to pick the tops here, and we're not trying to pick the bottoms here. Very difficult to do. But if a person used this strategy, you would see that this RSI 30 line is below the 50 line for quite a bit of this move down in the markets. So the idea here with our two solutions is to possibly reduce as much as we can the stock market decline and also have some dry powder on hand so that when we do get a new buying opportunity, we have money so that we can invest. So I hope you found this information useful here today. I hope everything is going well for you. Leave a comment if you have any questions. Stay tuned for our next episode.